I've got an old dinosaur computer. Spencer used his last night. Oh, never mind.
Hi, we are from Washington State University, here to present a valuation on the Hecla Mining Company with the recommendation of buy hold. My name is Marge.
I'm Paige.
I'm Eli.
I'm Hua.
Hecla discovers, develops, and produces gold, silver, lead, and zinc. Their main goal is to operate as a low-risk company, and they do this by operating in politically stable areas as well as historically rich mine depots. We recommend a buy hold position on Hecla because of the large amounts of high-grade mineable reserves they have, as well as the rebound prices of precious metals and the development of new interests. As of right now, they have 4 main mines, while they also hold interests in new mines to be developed in the future. Their largest mine is Greens Creek. It's located in Alaska. They have 100% ownership of this mine and has a life of 10 years. The second largest mine in terms of reserve is Lucky Friday, located in Idaho. The construction of the number 4 shaft, completed in 2016, has increased this mine life to 21 years as of right now. The Casa Berardi mine, located in Canada, it's mostly gold. It was acquired in 2013 and has a mine life of 10 years. The last mine not shown in these graphs is San Sebastian in Mexico. It was acquired in 2015 and has a short life of about another year.
Hecla operates in a demand-driven industry, which is a really important thing to consider when looking at this market space that they're situated in. Anything that Hecla mines is able to be sold on the market, eliminating the risk of excess supply as well as holding costs. As you can see in the pie charts, the primary areas of silver demand include industrial fabrication, coins and bars, and jewelry. In 2015, industrial fabrication took a slight hit. This can primarily be attributed to the excess reserve that China and India has been holding, but we do expect this demand to ramp back up. There are also areas of unexplored value, including the cell phone market in India and China. Looking at the last 5 years, you can see that silver prices, which are positively correlated with gold prices, have been decreasing. First glance, it seems to be more of a hindrance rather than an opportunity, but due to the cyclical variance of metals prices, this decrease in demand leaves plenty of room for a favorable upturn. With the recent reaction to interest rate hikes, as well as the announced anticipated interest rate hikes, it is reasonable to say that the public has seen this as more of a precautionary move for the future. In a market with increasing uncertainty, market participants may move towards more physical assets which have less volatility. Ed Ballard from the Wall Street Journal also states that investors are beginning to buy as, quote, the great unknown of the Trump presidency looms. And as we learned yesterday, uncertainty brings opportunity. On another note, with changing administration, policies are starting to move more towards lax environmental regulations. This is big news for Hecla because this will allow them to do further, less costly exploration. Ultimately, all these points boil down to an expected increase in value for Hecla mining.
Hecla return on equity over the last 5 years has been very inconsistent with the falling trend. And the reason for this falling trend was because of the net profit margin. When you take a look into the graph, it was nothing less than a roller coaster. And the main driver for this roller coaster was because of the decrease in metal price, including gold and silver. Even with more mine added, the Hecla cost of revenue still remains so high, while the sales growth rate stayed at a very low level, was only 1.48% on average in the last 5 years. However, in the last quarter, when the metal price bounced back a little bit, Hecla did very well with its operation by generating about 2% return on equity. One more interesting thing about Hecla was 3.5 years ago, they borrowed about $500 million in debt in order to acquire the Casa Berardi mine, which mainly focuses on gold production and has huge amount of gold reserve. This acquisition has leveraged Hecla capital by a lot, much more compared to the other competitor. Despite of having huge amount of debt, Hecla seems to utilize the debt pretty well. as in the last 12 months, Hecla ratio of debt over EBITDA stayed at a much better level compared to the other competitor. Furthermore, the Casa Verde mine alone generated about 14 million in net operating income. You know, look how close they are to cover the interest expense, even with the unfavorable gold price. And we do believe that in the future, the return on acquisition could actually cover or even more than the cost of debt. Why? First, gold price will increase in the future based on our assumption. Second, this includes the last quarter of 2015 when gold price stayed at the lowest point over the last 5 years. And finally, Casa Verde mine is a very potential mine with huge amount of gold reserve.
Under our discounted cash flow model, we estimated a price point for Hecla of between $6.27 and $7.43. We computed our milling and treatment costs on the basis of payable ore produced for the year, whereas our other costs come as a matter of total ore produced for the year. Additionally, our production and revenue estimates are held constant, as Hecla is unable to simply ramp up production when the metals prices are favorable or slow down production when metals prices are not. These are held constant and outside of management's control, as instead they are a matter of efficiency. That being said, if you see 2016 has higher revenue totals than the ensuing years, and this is because the 2016 numbers are pulled directly from the corporate update published this January, which reflects the true production amounts, whereas our later year estimates and our constant estimates are based off of our own conservative projections, based off low-end figures from the 2015 10K. Additionally, we ran a scenario analysis on Hecla to see the relationship between the required rate of return and the equity value per share of Hecla. With respect to Benjamin Graham's 15% margin of safety, our estimate price for Hecla falls right around the current trading share price. Using CAPM to calculate our required rate of return, we calculated it out to be 5.2%, which gave us a very favorable share price for Hecla, about $7.40. That being said, given the current investment grade bond returns of about 3.7%, we found this estimate to be a little bit low. And as you can see here, as the required rate of return increases, the share price of Hecla decreases. But at the same time, as our metals prices increase, or metals price assumptions increase, the equity per share increases as well, which proves our investment thesis that as the metals price increases, the value of Hecla will increase as well. Additionally, our model only values Hecla for their 4 current operable mines over the length of their mine lives. Hecla, as part of their management structure, prefers to invest in areas which have historical mining, large mine reserves, such as Idaho or Alaska, Canada, and the area of Mexico, and Durango, Mexico. That being said, over their operating history, or to record a mine life, that is only based on the geological data of proven mineable reserves. Under Hecla's operating history, however, they're frequently able to extend the mine lives as they dig deeper and are able to perform more geologic surveys. Frequently, the mine lives are extended. For example, the Greens Creek mine has been mined for about 30 years now and has very rarely had a mine life of longer than 10 years, suggesting that there's great amounts of value hidden beneath the surface here. Additionally, in the recent years, Hecla has purchased mineral interests in Montanore, Rock Creek, and Donlin Creek, which, as the new presidency looms and the lax environmental regulations make the permitting process easier, the estimated 2.5 billion ounces of inferred silver reserves are becoming closer and closer to a reality of profits for Hecla mining.
While there's a lot of opportunity in these new investments they're making, there's a lot of risks. And the risks that we identified with the highest impact relative to probability include recurring losses due to the volatility of metal prices, political risks and legal challenges preventing development, such as environmental lashback or the proper permitting. So in conclusion, we recommend a buy hold position on Hecla because of the untapped additional value from mines not yet just done, conservative gold and silver estimates, and a low operating risk by the company.
So how does one have a buy hold rating? I've never seen that before.
Our valuation price, as you can see here, falls around $6.27. And The share price when we were kind of going through the written report and doing a lot of our analysis was much below that. However, in the boom after the presidency and the announcement of Donald Trump as our next president, the share price of Hecla grew as the optimism for environmental regulations being lax and things like that created a more positive atmosphere for mining. That being said, our mine estimates are inherently conservative because our production amounts are lower than theirs, lower than the current production amounts, and it creates this great amount of wealth that is undervalued by our model. And by that, we feel that it is a strong buy. However, under the current price, it hangs around right about what the current trading price is.
Okay, so it was a buy and then it creeped up, so then.
Although, would those market assumptions change your model at all? I mean, or are you guys fixed in your assumptions?
I was going to say, I think for this, we really tried to just press that there's a lot of uncaptured value in terms of unexplored things that we really don't have any sort of dollar value for that we can put into our trading price. So based off what they currently have, we think they're accurately priced, but because of all these opportunities that exist, they really can add a lot more to the value, but it's more difficult to capture that and have a relatively good margin of safety and be able to.
Additionally, the permit process, we think will lower the capital expenditures required to bring the new mines operational, which will inherently increase the cash flow of the mines once they become operational.
Because what you have here, you're not accounting for any new development projects or?
No, not in this, but in the future projects, they will be priced more favorably.
So if you guys are looking at that it's potentially an understated resource, did you look at the actual NAV calculation or a book value or something on the asset side? And if they provide an NAV, what assumptions are they using in terms of their resource prices?
A rough NAV we saw was that there was a possible value of these mineral reserves of about $1 billion. That being said, these mines are not fully developed, so estimates of costs and things like that are kind of throwing darts at the board at this point. They're 6 years out from being able to. Given Hecla's operating history and the mines that they choose to invest in historically, we feel that these values and these cash flows will be realized. However, the net asset value we have right now for those mines being as far out as they are is very difficult to quantify within our model.
I was going to say, as well as Paige mentioned, they have a really good repertoire of picking mines that do have long mine lengths as well as have very dense reserves of minerals, and so that's a strength of management, and so we see that going forward into their expeditions.
So you guys mentioned the Trump administration being a potential catalyst in terms of cost savings and getting new stuff developed with less regulation. Do you see any risks with the Trump administration?
Yeah, we actually talked about that in terms of importing and exporting and taxes in terms of that realm of stuff. Hecla actually exports about, I believe it's 70% of their goods, and so that is a positive for Hecla in terms of a comparison to other mining companies, which may be importing more goods and being taxed on those. So that would be definitely an advantage. Is there anything to add to that?
So basically up to 2015, so Hecla cost the buyers overseas from Hecla, there was Japan, Korea, China, and Canada. So these four countries take up to more than a lot of percentage of the total revenue of Hecla. So these four companies is a very strong company with low political risk that relate to the US. So I think that the risk is kind of minimized about that.
Relative to the industry.
Yes.
Yeah.
And then with mining operations throughout North America, and you're saying the four countries that they rely on for their revenues, what's their currency exposure look like?
Hecla, for the majority, likes to repatriate their earnings from what we can tell and keep everything into US dollars. That being said, their holdings in San Sebastian in Mexico and Durango, Mexico, they actually haven't been bringing any of those earnings back into the United States and keeping them in the peso down there. In terms of currency risk, I feel they minimize it for the most part by trying to keep as much as they can in the US dollar.
As well as operating, I mean, it's really close to the US. They operate in Canada and Mexico, and so that's Canada's a very relatively stable country, and so looking at that in terms of exchange rates, I think is a very minimal issue.
Did you take a look at management or any sort of more qualitative factors? to play a part in your investment decision?
A strong part of what we've learned about the Hecla management is part of what their investment strategy is. Over the past 5 years, Hecla has been undergoing, with the lower metals prices, undergoing less smaller revenue amounts. That being said, they've continued to invest, and what they invest in is essentially to be a hedge against the market in many respects, as they want to be low risk, they want to be politically stable, and they want to appeal to investors that are looking to invest in silver and gold, and they will be the proxy for that. And that's part of their management strategy is, I guess, to minimize themselves as a firm-specific risk and become just a proxy for the market.
So then why would an investor choose to invest in this proxy rather than directly into commodity?
I guess I would say the strength of management and their ability to invest in the correct mines or the right mines. Their mines historically have been largely profitable, whereas if you invest directly into the industry, you may be seeing more fluctuations of kind of taking the market as a whole. Their strength of management, we think, is relative to their peers strong and provides them, I guess, a baseline ability and a baseline competency that is, I guess, likened by investors.
I think it's also diversifying within an industry, because if I just pick gold or I just pick silver, I get the value of one of those. But in this case, I get the value of management doing more research, and then also I get silver, lead, and zinc. And so maybe because silver and gold are positively correlated, those will move in the same direction. But you have lead and zinc to kind of take on part of that and still generate some revenue, while there might be more fluctuation in the gold and silver prices.
Do you know why lead and zinc aren't correlated with gold and silver?
I would say factors of their demand, whereas what drives the silver and gold prices is different from what drives lead and zinc in terms of production amounts and what the metal is actually being used for.
So what were the commodity prices you used in your discounted cash flow?
So we held lead and zinc constant using a 3-year average for them because they experience less fluctuation, and none of their mines are primarily lead and zinc. They act as a byproduct. And as you can see here, it's a little hard to read on the slides, but we use $19 an ounce for silver and $1,300 an ounce for gold, which I believe today silver is $17.57 and $12.21 for gold at the moment. So these are relatively conservative given today's prices, and our price assumptions, of course, move 6 years out, so we're looking for an average over the next 6 years, which we hypothesize to be optimistic. Down here is our more bearish assumption with the blue line here, which is $15.70 or $15.70 and $1,160 for gold. And then up here is our more bearish estimate of $22.15.
With so much sensitivity to commodity prices, do they do any hedging to try and?
I think lead and zinc inherently act as that hedge, as they're uncorrelated, and their revenues will offset to a degree.
Did you guys look at any peer group analysis in terms of where they're trading relative to price to sales, price to earnings?
So, I'm sorry, what's that again?
I'm just curious in terms of if you look at any of their, where they're trading in the market on a valuation standpoint relative to, say, like a Pan American Silver or Rico Gold or any of their other.
So basically, from what I did, so I think that Hecla has a very better position than most of the company, but there was one company that specialized in gold that I was not included in. That was the Newton Gold. Mm-hmm. So because they specialize in gold, and the capital is much bigger than Hecla. So I feel that company is the only company that's performed, I think, that much more better compared to Hecla. But given the different capital, they have like huge market cap and huge debt as well. So for the other companies that in the industry, I think that Hecla performed better than that company.
And with that, one of the things Hecla did very well during this recent downturn in prices over the past couple of years, their share price themselves dropped to about $1.60 within the last 5 years. But what Hecla did is invest in the future. At one point, 5 years ago, they only held 1 mine, and they've since grown that up to 4 and continued purchasing interest, also issuing some debt as a result of that. Whereas everyone else was suffering from the prices and